Candlestick chart explained. Candlestick chart and other chart types. A candlestick chart is a widely used method to visualize price movement in the stock and financial markets. It displays open, high, low, and close prices within a specific time frame, offering a detailed snapshot of market behavior. Other common chart types. Line chart connects closing prices over time. Simple and clean but lacks detail. Bar chart shows open, high, low, and close, similar to candlesticks but less visual. Heikin-Ashi, a smooth version of candlesticks, used to filter out noise. Renko chart focuses on price movement only, ignoring time and volume. Why candlestick charts are most popular. Provide more detailed price information than line or bar charts. Visually intuitive and easy to interpret for patterns and sentiment. Help traders spot reversals, continuation patterns, and market psychology. Widely supported across trading platforms and educational content. While each chart type has its own pros and cons, candlestick charts are the most commonly used due to their clarity, depth of information, and versatility across trading styles. This is what a candlestick chart looks like. Each candle you see on the chart represents price movement for a specific time period. It could be 1 minute, 1 hour, or even a full day, depending on the chart settings. The green candles show periods where the price went up, while the red ones show when the price went down. Together, these candlesticks form patterns that help traders understand market trends, momentum, and potential reversal points. Let's break it down further so you can see what each part of a candle actually tells us. Anatomy of a candlestick. A single candlestick represents price movement over a specific time period and reveals 4 key pieces of information. Open, the price at which the asset started trading during that period. Close, the price at which it finished trading at the end of the period. High, the highest price the asset reached during that time. Low, the lowest price it dropped to within the same period. This data helps traders understand not just where price moved, but how it behaved during the time frame. Bullish candlestick. If the close is above the open, the candlestick is considered bullish. This means the market moved up during that time period. A bullish candle indicates buying pressure or positive sentiment. It is typically displayed as a green candle on most charting platforms. Bearish candlestick. If the close is below the open, the candlestick is considered bearish. This indicates that the market moved down during that time period. A bearish candle reflects selling pressure or negative sentiment. It is typically shown as a red candlestick on most charting platforms. Components of a candlestick. The body of the candle, the thick part between the open and close prices. If the close is greater than open, the body is usually green bullish candle. If the close is less than open, the body is usually red bearish candle. Wick or shadow. The thin lines extending above and below the body, showing the highs and lows beyond the open and close range. Upper wick. The line above the body of the candle. Lower wick. The line below the body of the candle. Understanding the body of a candlestick. The body of a candlestick, the thick portion between the open and close, shows the strength of price movement. Long candlestick bodies. Bullish candle, green color candle. Close is greater than open. A long body indicates strong buying pressure. Buyers are in control, pushing prices significantly higher during the session. Bearish candle, red color candle. Open is greater than close. A long body shows strong selling pressure. Sellers dominate the market, driving prices down with confidence. Short or small candlestick bodies represent weak price movement or indecision in the market, often seen during consolidation or low volatility periods, may signal a potential pause or reversal, especially when combined with other patterns.